Great. Well, thank you very much, Mariam, for asking me. And I have to say, when you asked me, I thought, what do I know about money? What do I know about inflation? I just happen to have been a central banker for some time, but let me try. What we have today is really a discussion of the roots of inflation. And we have, to set the stage for what we're going to talk about, think about two regimes after the collapse of the Bretton Woods system. We had the pre-1980s regime, and we had the post-1980s regime. And what came in between was really, in many ways, a marriage of theory and practice on how to fight inflation. On the theory side, we had the famous Skidland and Prescott rules versus discretion paper and follow-on papers after that. And on the practical side, we had Paul Volcker, who raised interest rates very, very high and managed, according to many, to defeat inflation in the United States once and for all. And in this theory and practice, there was a central role for expectations. And given that expectations had to be contained by the appropriate rules, essentially central banks went to an anti-inflation mandate. The popularity of inflation targeting starting in New Zealand towards the end of the 80s and spreading across the world. And the idea is they would be given a mandate and they would be given operational independence. And that combination would replicate what happened in the United States and bring down inflation everywhere. And it worked. Countries across the world, from Britain to Brazil, brought down inflation often after adopting inflation targeting. And these were countries, Brazil, for example, had historically high levels of inflation just prior to moving towards the regime. Now, obviously, academia started questioning at some point, was it really central banks in this new regime? After all manner of countries brought down inflation, regardless of their macroeconomic conditions. And the question was, could it have been the global environment? For example, some have argued that the growing integration of labor markets around the world, essentially the arrival of China into the global labor markets, created a lot of competition between countries, and that depressed the wage setting power of unions in industrial countries, had some effect on inflation over time. Others argue that perhaps this was the disinflationary effects of stronger productivity growth in countries like China, a growing global productivity wave, and this created what some people call good deflation or good deflationary forces because of the enhancement globally in productivity, even if productivity in advanced countries was much slower. And then there are other arguments that somehow, because of aging, because of the export-led strategies of some of the emerging markets, again, especially China, we had a savings glut. That's Ben Bernanke's term. Other terms are secular stagnation. And these, more recently have become the focus of attention as central banks have found themselves singularly unable to raise inflation. Because the problem that emerged in the 2000s was that, if central banks, were responsible, they were too successful. The new problem was too low inflation. And as we know, as economists, some inflation is good to deal with frictions such as the downward stickiness of wages. One way to deal with a situation where real wages are too high is basically have nominal wages go up at less than the rate of inflation. That way you bring down real wages. So having too low inflation makes it difficult to do these things. Similarly, on the monetary side, with very low inflation, the zero lower bound for interest rates starts kicking in which case you get excessively high real interest rates, and that may again impede economic growth and activity. And the biggest worry, of course, of really low inflation was that we would get debt deflationary downward spirals. Deflation itself would spiral downwards. And this was the theory everybody worried about, citing the example of the Great Depression as something that developed countries could be facing. And of course, Japan soon became the poster child for the downsides of poor monetary management. As you know, Japanese growth collapsed from close to 4.5%, 5% in the 70s and the 80s to 2 or 3% in the 90s after a period of fairly slow growth post the bubble collapse in the late 1980s. And Japan has had really low inflation mingled with periods of deflation. And this has been a worry for many scholars. How do we get out of this? As a footnote, Japan has never had spiraling deflation, which is the worry that many people have of the consequences of deflation. Nevertheless, hordes of academics descended on Japan to offer monetary advice. Some, offer the caveat, maybe there's nothing wrong with Japan. It's simply a consequence of population aging and a declining labor force. If you look at per capita output, it looks very comparable to Europe and the United States. But generally, there was a sense that Japan was, or Japanization was the coming problem for industrial countries. And to avoid that, you had to act early and in fact, undo the lessons of the past. And Paul Krugman said this very, very vividly, that rather than focus on credibility, focus in a sense on undoing credibility, have a credible commitment to engage in irresponsible monetary policy in order to start getting inflation up. And the idea here is the worry that people may have is as soon as inflation comes up, the central banks will revert to form, and given their mandate, will tighten monetary policy. If you want to come out of the deep hole of very low inflationary expectations, you need to be able to commit that you will go to much higher levels of inflation, and that requires a reverse kind of commitment. Others have proposed, Olivier Blanchard, for example, raised the inflation target. And of course, what he had in mind was that by raising the inflation target, you make it possible to have more inflation before the central bank feels compelled to come in. Effectively, that means a higher inflation path. Of course, people criticize that, saying you can't even raise inflation in the first place. How do you raise the target and expect to meet that? And obviously, what he meant was you deal with you have a greater effect on expectations. Others have, as the Federal Reserve has argued recently, have a symmetric target. Again, run the economy a little hot. If it has been running a little cold, that is another way of being somewhat irresponsible on the higher side so that inflationary expectations can be pulled up. Other forms of price level targeting, exchange rate targeting, forward guidance, all these, important to say, essentially by the argument that what the central banks did was change expectations, and perhaps they've been overly successful. And now, for a variety of reasons, not just the central banks doing, inflationary expectations are too low, they need to be elevated. How better to do it than, again, focus on changing the quote unquote rules so that expectations change. And of course, it's not just the rules that central bankers have tried. They're using new instruments both on the short end and the long end. On the short end, negative interest rates. Of course, Marcus has talked about the fact that perhaps if you go too negative, you get a reversal interest rate because of the depletion of bank capital. You've got Ben Bernanke coming out with quantitative easing. Japan has been in the forefront of many new techniques, flooding the market with reserves, for example. And of course, most recently, arguments that we need to move towards monetary financing of the fiscal deficit, precisely what many developing countries and emerging markets got rid of in the past in order to quell inflation. Of course, there are new concerns about what is happening with central bank policy. Does the easy money create excess liquidity? leverage, and financial stability risks. And could this, in fact, be keeping inflation low? Because what you have in mind is a market anticipating a regular set of crises, one crisis after another, which effectively makes low growth for long credible and keeps inflation and interest rates low. So it's financial instability, which in a sense verifies expectations which are really low in terms of inflation and growth. Another concern is whether there's a prisoner's dilemma feature across central banks. That is, once you get into this low for long, no one really wants to normalize because there's a risk that exchange rate appreciation would hit them first and consequently slow their growth. And this is a concern that some have. Others see a new opportunity in this wonderful world of low inflation. Of course, I'm referring here to modern monetary theory, MMT, that John Cochrane refers to as magical monetary theory. And the idea here is, why not spend until inflation picks up? And, given that happens only when we get to full employment, given that many economies have substantial slack, this is nirvana for those who want to spend. Bring out these spending plans and finance it by printing money. I think the focus on printing money to finance is a little besides the point. But essentially, the argument here is Japan shows the way. Spending without inflation, they've elevated debt to GDP to astronomical numbers, but still interest rates are really low. So MMT now is a challenge because many political authorities embrace it as the way forward. So coming to the two papers in the conference then, given this scene setting, they complement each other nicely. They have a lot of similarities, apart from the fact that they each have three authors, two with German origin names and one with Eastern European origin names. But there's more than that. They span the two regimes. Drexler, Savov, and Schnabel look at how inflation was brought under control pre-1980s, and they tend to be a little more dismissive about the role of expectations and the credibility that Volcker brought in. Brunemeyer, Merkel, and Sannikov focus on a different question, which is the question that we talked about for today. Why does Japan not still have inflation despite meeting all the conditions for fiscal dominance? Why is it possible that MMT may be right until it is not? And they raise the question of the risks associated also with an MMT-like structure. So they really span both regimes we talked about. Last 2 minutes, let me explain these very different approaches, leaving it to the discussants to fill in the details. In Drexler, Schnabel, and Savov, DSS, it's not really about central bank credibility or the role of expectations. That may be embedded if they wrote a theoretical model, but essentially their argument is regulation Q suppressed deposit rates. That made savings unattractive and boosted consumption demand, especially when regulation Q started binding. Also, because deposits growth was slower in those situations, bank lending also fell off, resulting in muted investment and supply. And so you had stagflation, demand increasing because people moved away from savings towards spending, and supply not keeping pace because credit growth was relatively slow. It's an interesting idea. What is astonishing is how much support they find for it in the data, and I'll come to that in a second. But the main point here is that Volcker, central bank credibility, and expectations were peripheral to this story. In a sense, the nature of this paper is basically saying the true reason it came down is something nobody really has talked about, which is regulation Q. And of course, on par with their earlier work on the deposit channel of transmission, they find effects which a priori I wouldn't think they would find, but seem very persuasive once they find it. So it certainly complements their earlier work also on the deposit channel of transmission, because it's an example of how deposits matter. just a couple of thoughts without attempting to preempt the discussion. The big question here is, could the depositors not substitute to other forms of financial investment? For example, there was a period when SNLs were offering more. Did they actually move to the SNLs? And could they have moved to other fixed income instruments? Why didn't those start up? Also hard to see the effects in aggregate savings. I've looked at aggregate savings over this time. I guess patterns are in the eye of the beholder, but you would expect to see aggregate savings fall considerably, and they don't. And lastly, a question, should local inflation be non-traded rather than traded goods, especially when you have different regulations binding across different areas in the United States? Do they find it? That's a question that they can perhaps answer later. Turning to the BMS paper, essentially, this starts with the fiscal theory of the price level. Basically, that theory says the price level is a plug number that equates the present value of real government surpluses to the nominal value of government liabilities. And by government liabilities, we include money and bonds, which is why the emphasis on money in the MMT world is perhaps overly extreme. But the question here is, Japan has been running deficits for some time. If you extrapolate that going forward, it's a negative present value of fiscal deficits. Let's assume there's some reason they turn it around. Nevertheless, any present value of fiscal deficits, given the mounting level of debt, should imply the price level in Japan should be going up. That it has not is a puzzle for the fiscal theory of the price level. And of course, BMS say, well, maybe there are some other terms which people value and which are such that you can actually issue additional government liabilities and still not get what the fiscal theory of the price level suggests, higher prices, a higher price level as you issue more of them. And essentially two other sources of value they point to. One, they emphasize in this paper, the value of government liabilities as safe assets, which helps the private sector deal with idiosyncratic risk, and the value of money in payments. They don't focus on that here. Now, the whole point of the paper is these additional sources of value can grow perhaps even faster than the economy. They have a bubble-like feature and can be used by the government to issue additional non-inflationary debt. In other words, debt to GDP can rise without inflation, explaining Japan. Is this nuts? Obviously not. Think about Bitcoin, no real source of value. Of course, it is protected against overissue, but there's so many things that are protected against overissue and have no value. Bitcoin seems to have value. Why? That's really the bubble-like feature that one could argue that BMS focuses on. They have a warning to the MMTers, I think, which is that when confidence collapses, the descent into inflation can be much more dramatic than you think. Of course, when that happens, it could happen a long time from now, in which case they're sympathetical with the MMTers. So the real issue is they focus much more on forward-looking expectations and how much are these forward-looking expectations important. In a sense, they take a very different view from DSS. And essentially, you need expectations that there will be a bubble in government assets, and that bubble can be, in fact, exploited to raise more government debt. I'm happy to send other comments separately to the authors, but these are two great papers that span very interesting aspects of the problem, and look forward to the presentations and the discussion.